welcome back to another summer school class brought to you by eToro. I am Sam North, the trading school lead, and today we are focusing on when should I start investing. The first thing to mention in regard to this question is it actually follows on quite nicely from our last video, can I afford to invest? Ultimately, you shouldn't start investing unless you can afford to. Remember, we talked about asking yourself 3 questions to help determine whether you are ready. We asked, do you have an emergency fund? Are you committed to leaving the money in place for a few years? And can you weather the ups and downs of the market? So, if you have money available in case of an emergency and you can answer yes to questions 2 and 3, you are in a good position to get started. In this video, we will talk about the difference between starting earlier and later, but also stress that it is never too late to get started. We will also review whether you should try and time the market every time you invest, or if dollar cost pound averaging is a better way to go about it. We will also touch upon investing in a period of market uncertainty and discuss whether this is a wise thing to do. Over the last 2 videos, we have stressed the importance of being patient, having a longer term investing mindset, and reinvesting your returns. Let's now look at some of these numbers which will back up starting investing as soon as you can. Look, it won't be a surprise to hear that the earlier you start, the better. But let's at least get some numbers and stats together to back this up for you. For the example, we will use individuals investing $100 a month and receiving on average 5% annual compound interest return. Again, let me stress the returns could be higher or lower, and of course you can invest more or less. Remember, the average return of the US stock market is 10%, so we are looking at the lower end of things here. So say we have 2 people, one called Dennis and one called Thierry. Both Thierry and Dennis will retire at 65 for the sake of this example, and as we mentioned, they will both invest $100 every month and see a 5% return. Thierry starts investing at 25, whereas Dennis starts at 35. That extra 10 years worth of investing can make a massive difference. Thierry will have about 160,000, whilst Dennis will have 89,000 by the time they're both 65. Thierry's account is almost double Dennis's account, and he only invested 12,000 more of his own money. This example shows the difference of starting 10 years earlier, but investing the same amount every month for 30 or 40 years. Of course, as people get older, get pay rises and so on, they might invest more each month than they would have at the beginning of their investing career. Last week, we said using the 50-15-5 rule is not a bad way to go about it, with the 15 representing investing 15% of your take-home pay. I can imagine some of you wondering why 10 years makes such a huge difference, so let's cover that now before going through one more example. When thinking about investing as young as you can for retirement, it might not make much sense as it is so far away. But the difference could literally be tens of thousands of dollars or pounds or whatever your favorite currency is, all thanks to compound interest. Remember I said supposedly Albert Einstein said it's the 8th wonder of the world? Well, let's discuss that. As a snowball rolls down the hill, it starts to grow as it gathers more snow. Now, not only does the original snowball grow in size, but each additional pack grows too. I said we would discuss one more example, so let's do that. For this one, we will use the average stock market return as our base, so that is 10% on average. But this time we will use an example of someone investing $200 a month. If you started at 25 years old and invested that $200 every month till 65, how much do you think you would make? Pause this video and have a guess. The power of compounding is just incredible. And believe me when I say I had to check this answer many times just to make sure I was right. The answer, $1.2 million. That person would only have invested $96,000. But the power of compounding, reinvesting your returns, and regularly reinvesting means that they would have had a total investment value of $1.2 million. Now, some people will be able to afford more than $200, so just imagine what those numbers could look like. For a comparison, instead of that person investing for 40 years, what would it look like if they had invested for 30? Their investment value would be $450,000, well under half of the other person. The earlier you start, the better. The numbers do not lie. Next up, let's talk about whether timing the market is better than just averaging in every month. Firstly, it is worth noting that it is incredibly hard to time the market. That includes highs and lows. If we just rewind to 2020, it was very hard to precisely call the market bottom, and there were many incredibly smart people that thought the market would continue lower when it started to recover. As an investor, if you were to successfully buy or sell at the very low or high, there is no doubt that that would be a very rewarding strategy. Let's review some pros and cons of regularly investing every month, dollar cost averaging, versus investing a lump sum at a specific point. A con of DCA, and therefore a pro of lump sum investing, is that markets do tend to go up over time. So if you do buy a lump sum earlier or after a big dip in the market, the returns are likely to be greater than if you just invested the same amount every single month. However, as mentioned, timing the market is tough, and therefore a pro of DCA is that it can help to avoid bad timing. Investing a large sum at one time runs the risk that you could have invested just before a big market fall. Imagine investing a large sum in January 2020, just before COVID, or before any other decent sized move lower in 2018, 2015, 2011, and of course the great financial crisis in 2008. The good news is that the market has recovered from all of those, but DCA can help you avoid investing everything at the worst possible point. This can also help reduce the emotional component of investing. In a future video, we will cover this in more detail, but by investing the same amount every month, for example, you aren't just tied to one price like you would be if you had invested a large sum at once. Some investors will try both of these strategies. They might invest the same amount every month, but if the market takes a bigger than usual dip, they might invest a larger sum to take advantage of the potential recovery. Again, there is no guarantee that all markets do recover, but this is the theory. At the end of the day, if someone was to be able to time the market efficiently, then this is a great way to invest, and you can see bigger returns than someone who dollar cost averages. But it is worth noting that the market is very hard to time. A combination of the two is not a bad way to go, whether it is adding a lump sum on a 10% dip or a 20% dip, for example. You might be watching this video during a period of market uncertainty and wondering whether it is the right time to invest. Well, as the saying goes, bull markets are built on bear markets and last longer too. So while there is no guarantee the market can't go lower, investing during a period of downturn can be fruitful if the market does recover. Dollar cost averaging can help with smoothing out the volatility, but could limit your returns compared to timing the market perfectly. If anyone can time the market perfectly, by the way, please do let me know. In summary, in this video, we talked about why investing earlier is better, but what I do want to stress is that it is never too late to start. We looked at the importance of compound interest and reviewed some numbers to make it make more sense. Lastly, we then reviewed whether investing regularly was better than investing more at one point in time. The next video will focus on what type of investor are you? Do you already know? Let me know in the comments below. See you next time.